Yeah, I certainly think the dollar will come under pressure in the second half of this decade. You get through this global bust, and I think that will be the peak in the dollar, and it'll be all downhill from there. How fast is hard to know because this is going to be a global bust, and as we know, when we catch cold, the rest of the world catches pneumonia, and this is going to be us catching pneumonia. So the rest of the world's going to be in really rough shape. I just don't see where China, Russia, or anybody else is in a position to replace the dollar as a trade currency. So they can talk about it all they want and try to plot against the dollar all they want. I think it's going to be a long process. So certainly the next 5 years, the dollar is still going to be, the king of the hill in terms of trading, in terms of trade. Um, as we get to later in the decade, I'm forecasting a huge inflation cycle as a result of um, what the Fed has to do, and also central banks, frankly, have to do during the bust to counter the bust and pull us out of it. It'll be a free falling financial system during the bust, and so they're going to be printing and printing and printing. Probably my estimate is be something 4 or 5 times what we saw in 2020, 21. So, I mean, 20 trillion coming out of the Fed is my estimate. Could be a little less or more. But that kind of number is going to trigger, and all central banks doing something similar proportionally, that's going to trigger a huge inflation cycle that will far surpass, I think, the early 80s and certainly what we've seen of late. And so as you get to the end of the decade, you could be looking at, high double-digit interest rates, high double-digit inflation, and obviously a budget that can't be serviced, or we're going to really struggle. Again, it's a worldwide problem, but focused on the U.S., I think we're going to have a hard time making the case that the dollar is something sound and where people want to be. So, later in this decade, I think the dollar is going to be under a lot of pressure. You could see it that DXY could be under 50 by the end of the decade, and then keep going from there. So I understand the concerns about de-dollarization. I understand all of that. I just think those that are in that camp and think it's something that's coming very quickly. I think it's quick in terms of history, yes, but quick not in the next year or two.
Yeah, that's an important distinction. I do want to dive into your theory of this global bust in a moment, but before we do, I want to touch on silver here because silver nowhere near its all-time highs. To call it a disappointment for many is kind of an understatement. It has had quite a lackluster performance since the last time it was at its all-time high around 2011. I'm wondering what your thoughts are on silver. Do you view it as a similar asset to gold at this point? Has it become more of an industrial metal in your view? What are your thoughts on silver and how it could potentially perform up ahead?
I think silver still is poor man's gold. So it does have some of the characteristics of gold, but it also does have more of an industrial, you know, piece to it. So, yeah, it's been, I think it's an understatement to say it's been a disappointment. It's certainly been kind of the asset that has just not performed for a long time, and has disappointed lots of us, including me, over a long period of time. I do think you have to kind of step back though and realize, because I think a lot of the bears on silver, or those that were bullish and got really beat up by it, they they think it's been, since 2011 nothing's happened. Well, you had a pretty good run in certainly the silver miners and in silver in 2016. You had a very fast big run coming out of the pandemic. March 2020 ran to August 2020 with a really big run there, and then from there it's been a really difficult slog. So it's been consolidating. A lot of the problem, I think, has been the dollar, and it just, silver gets hit a lot harder than gold when it's, in that period of strong dollar. So I think it's all set up now, um, where you've come down to some very important support lines, technically, where fundamentally silver is, because of EV, et cetera, silver is going to be in demand. There's, it's a metal that's going to be in short supply. And it does have the characteristics of when gold runs to 3,000, it's going to get a bid. So I have a pretty aggressive forecast pre-bust again of $60, which may seem unbelievable given what we've dealt with this last decade, but $60 between now and the bust. And then, and I've said if it breaks above 60, you could run to 75 very quickly. So 60 is my target, but 75 wouldn't surprise me. And then it will get hit harder than gold in the bust. So what that means, if we, you don't know whether we're going to 60 or 75 or 50 or whatever. If I'm right, it goes to 60 plus. You could see it back here, certainly, in the bust. And given it's, how easily it can move down, you might even see it down into the teens. So, I do think people have to be aware it's not a straight line post bust because of what I see coming as a huge commodity cycle. Post bust, I think silver could get to $500, gold could get to 20,000. But people just have to understand there's, it's not a straight line. There's this bust in between. As I say, it's like standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across. And obviously you can't. We're going to have that big canyon in between. So, those that think you want to own silver or gold and just hold it right on through, particularly silver, understand what you're doing if you do that, because it's going to be painful.
Interesting. I would like to now get your thesis on this global bust you see coming. What are the main catalysts that are driving it? How can investors protect themselves from it as well? Are there any asset categories that you currently see that can provide some shelter from the storm that you see coming?
First, my reasoning for a global bust, and I've been forecasting this or talking about this for a while, as what would come after we had this so-called melt up in the market. My reason for forecasting global bust, which I view as kind of 2008-9, and what would have come then if we hadn't kind of stopped from going over the cliff when the commercial paper market froze and GE almost went under, et cetera. The government reacted just in time and saved us from a bust then. So this is kind of that next step, because I think we probably won't act fast enough, and because we had a lot of leverage in 2008-9. We now have leverage on steroids. I mean, we've got 320 trillion in global debt. We've got quadrillions in notional value of derivatives, which is leverage on the markets. Debt is leverage on the financial system or on the economy. Derivatives is leverage on the markets. So you put those two pieces of leverage together at levels we've never been at before by a long shot. And leverage can enhance on the way up, but it can really destroy you on the way down. So that's probably the reason why I think what would have been a normal downturn is going to turn into something much worse. You add to that all the fragility that comes as a result of the pandemic. We've statistically come out of the pandemic, but there's still a lot of imbalances and things that resulted from that pandemic. And so I think they operate underneath the surface, and we can kind of forget about them because everybody's focused on what's the GDP number or what's some economic data number. But below the surface, small businesses are certainly not in the same place they were 5 years ago, et cetera. So and we've got a labor situation that's very different than would have been if not for the pandemic, et cetera. So I think it's leverage plus the fragility plus what I think will prove to be a big central bank policy error, because it is global, so it's not just the Fed. They're all fighting what I think is the last war, which is inflation. They got so surprised by the breakout in inflation after decades of disinflation that I think they're going too far in terms of wanting to see the results of everything they do. There's maybe a 9-month lag to policy, 9-month or year lag to policy versus the economy. There's probably a 2-year lag to inflation. So if you think about what the Fed is doing in terms of saying, and Powell speaking today, obviously to Congress, will probably repeat it. They want to see more done to inflation. They want to see the results of their policy before they move. If you've got that kind of a long lag, you've already gone too far on the tight side, and by the time you realize you went too far, you're in a bust. So it'll start with a recession, but then I think because of the leverage, move into a bust. And timing is tough. It's something we haven't had a bust in the post-World War II era, so I can't pretend to know what month it starts or what quarter it starts, but I think it could begin before the end of this year, may not, and then I think 2025 is probably the bulk of it. But so that's the bust I am forecasting. As to how you deal with that, along with the bust, I'm expecting an 80% bear market in the U.S. equity indexes. So again, we haven't seen that in the post-World War II era. We were down 65 or 6% in 2008-9, I think, and we haven't seen anything like 80%, except in 1929 to 32, we were down almost 90%. So I mean, that's a big deal. People are going to need to protect themselves, and we're in a melt up before we get there. So people have fought this market. I've been a lonely bull from 3,500 on up, and you're now seeing some capitulation, people starting to come in and be more bullish and raise their targets on the S&P to 54, 5,500. I'm at 7,000 on the S&P, and I think that could happen maybe by mid-year, maybe by summer. And it's a melt up because I think we've gone since last October pretty vertical. It's just going to steepen right into the top, so parabolic. But then from there, whatever the top is, whether it's 7,000, it could exceed that. From there, you could drop 80%. So it's going to be important for people to fight their own emotions, because at the top, I can promise you, everybody, including institutional money managers, including other strategists, they're all going to be all in. It's psychology. At the top, everybody's bullish. There's going to be a reason why we're at 7,000. It's going to be compelling that it looks like the Fed's done its job and they're going to ease and the cycle's just beginning, all of that. And it's going to be very hard to fight that, but you're going to want to fight that. Again, I'm not saying pinpoint 7,000. I don't know whether I'll be right about that number or it'll be higher. I think it's going to be up near there. But on the other side of that, if you stay stay fully invested and do the buy and hold, etc., you can have a steep ride down. And so protecting yourself is going to be important. The areas that I think can help people protect their assets in the bust are treasuries. I'm forecasting that the 10-year can get down to 0 in the bust for 2 reasons. One, we're going to have, ultimately, this will be a deflationary bust. It won't start out in deflation, but by the time we get through the bust, it'll be deflation. And number 2, central banks, the Fed's going to be printing money like crazy. How do you print money? You basically buy from the dealers. QE is basically buying the treasury securities from the dealers, everything from T-bills on out to 30-year bond. And so there's going to be, they'll have an insatiable demand for any treasury that's out there. There'll be plenty of new treasury supply to feed them as well, because the monetary expansion will be matched by fiscal expansion. So I'm not endorsing this. I'm not saying this will end well. I'm saying this is inevitable. When they're faced with a free falling financial system, they meaning all the central banks, they can't sit back and say, "Oh, we can't do this again." They're going to say, "We got to do whatever we have to do to save the system." So you will see this. And again, I can be off in magnitude, but I think it's pretty inevitable. This is where we're headed. So treasuries will be one place where you can get where I think you will see appreciation during the bust, and certainly will protect your capital. I'm not worried about the government defaulting on those treasuries in this cycle. So, because of the printing press. And so that's probably the one area where you can protect yourself. And then again, for some people, the US dollar, if I'm right, that gets a flight to safety bid. And it goes from 80 to, possibly 120. Those will be the two areas that will be bucking the downward trend.